topics. So hello everyone, we are starting chapter 5. Seems like we just started the course and we're already at chapter 5. I just want to give kudos to most of the class for doing very well up to this point. I want to encourage those that are not doing well to please reach out to me. I will be glad to help. I can either give you some time on WebEx, or if you're in Charlotte, I don't mind meeting in person. Just let me know, and because I want to see you succeed. All right. So tonight we're going to be talking about some things about business that everyone needs to learn about and recognize. So we're going to be talking about fraud, internal controls, and cash. So fraud and internal controls, a couple new topics for some of you. Fraud is generally defined as an attempt to deceive others for personal gain. So meaning they just want to steal your money, but from a business point of view, they are doing something that is not right. For example, an employee fraud is often grouped into 3 different categories. You have your corruption, which is those at the top of the house that are telling the accounting folks, hey, do this way and this way, and we want it done that way, and no questions asked. And most of the time the employees need their jobs, so they're going to do what the bosses say. So that's corruption. Asset misappropriation. What that means is theft, that employees or those at the top of the house, the managers, they're taking assets, whether most of the time it's cash, but it could be other assets that's being taken. So that's asset misappropriation, meaning it's not being used for the business. And then financial statement fraud. This is very popular. So what happens here is the accountant is putting things where they don't belong to make the company look better than it really is. And so I don't know if you guys are old enough to remember, but the Enron catastrophe years ago, and then other things just come to light when usually people get caught. That's the main thing. These things, there have been controls set up so that these things can be captured. Accounting firms are not out of the fraud business. We had some employees for a Big 4 company, can't remember what year it was, maybe during the financial crisis in 2009, but the company didn't realize it, but some of their employees were doing that to their clients. So it's a trust factor. And so what companies have done is gone to using controls. So fraud, this is the fraud triangle. So there is an incentive, go back. So the reasons for fraud are incentive, of course. If you got cash in the bank and it's not being used, some people might say, oh, they're not going to miss this little bit. If you got millions of dollars in the bank, they're not going to miss this little bit. There's also opportunity, cash, checks, whatever. They don't make it to the bank. Who knows what happened to them, but they never get recorded. So again, you got millions of dollars in the bank. They're not going to miss this little bit of money. And then there's rationalization. If someone is desperate enough, they're going to talk themselves into it because of this excuse or this reason or another. So these are the different things that push people to commit the fraud. So back in the 30s, and some of you may know about the SEC, the Security and Exchange Commission. It was developed to put a handle on these kinds of things, because normally if the stock exchange crashes or a company starts losing money and they don't know why, there's reasons behind it. So Sarbanes-Oxley Act actually created some things to help control these kinds of activities in the businesses. Number one, if you are caught, there are stiff fines and prison terms. Embezzlement is big in the big corporations, and if that happens and the employee gets caught, many times they're spending time in jail, on top of thousands or even millions of dollars in fines. The Internal Control Evaluation Independent Audit Committee, that is where audits are done to see if the financial statements are being done correctly. They will go into the transactions to see how they're being entered. And then tip lines, whistleblower protection, and ethics codes. Many companies are putting these things into effect as well. Many of your corporations, especially in the banking industry, you're going to have internal audits. So what that is a full department that is geared towards controlling what's happening in the books, what's happening in the manufacturing, what's happening in production. Internal control is very important when it comes to preventing fraud in the company. So internal control consists of the actions taken by people at every level of the organization. It's not just one person's responsibility, but it's everybody within the organization. For example, in your operations department, you have your cashiers that are on the registers, you have your stock people that are taking stock in off the truck, you have your managers that are overseeing all of this. Anything that someone does to help the business run, that's operations. So there's controls with that department. With reporting, we just talked about internal audit. It doesn't have to be an internal audit. It could be the managers just coming in and saying, okay, show me where this number came from, show me where this number came from. And so there's controls on the reporting. But there's also some automated controls in reporting now that are being used. And then there's compliance. Compliance means focus on adhering to the laws and regulations. Not only the rules of the business, but also state laws, federal laws, compliance. In the banking industry, you may not know this, but there are a ton of reports that are done by every bank, no matter what size it is, in order for the government to help regulate the banking industry so that we don't see ourselves back in a disaster like what happened in 2007, 8, 9, with the mortgage debacle, as I call it, where companies were getting people into mortgages that had an an adjustable rate mortgage. What that is you sign the loan agreement for a certain percentage rate, and at any time, according to the contract, your payments could go up. I was one of those people. I signed my contract, I had a payment I could afford, and that lasted for about 5 years, and then my payment jumped. It jumped to 50% more of my payment. So rather than paying $1,000 a month for a mortgage, I was now paying $1,500 a month for a mortgage. And I bought my house in 2001. So I had my house for quite a long time. But when that hit, and I was a single mom of 3 little ones at that time, I couldn't afford $500 out of my budget. Looking back, there were other things that I think I could have done, but I ended up selling my house in a short sale. But a lot of people lost their homes to foreclosure because of those kinds of things. So with that, the federal regulators came out with some more banking regulations that they have to follow. So these 3 things, it's important for everyone to play their part when it comes to controlling fraud. So most organizations use control components as a framework when they analyze their internal control systems. They have a control environment, refers to the attitude and the people in the organization and holding each other accountable. It's influenced by the policies that the company sets up, the character of the people they hire, uh, based on sometimes people may not, or companies may not do background checks. That is an internal control issue because you want to make sure that you're bringing on people that you know about them. Not necessarily that you're not going to hire them, because a lot of people deserve another chance, but you're going to put some boundaries in those kinds of relationships. But you got to have the internal controls in order to control that environment and control the people that they hire. In a strong control environment, when employees know that these kinds of things are in process, then they are more apt to be trustworthy, more apt to do their job well, and keep the company afloat. Then you have risk assessments. What's going on with your managers? What are they doing? They should continuously assess the potential for fraud when it comes to operations, reporting, accounting. They want to know, is how we're doing this risky? Could we lose something in this process? So many of you getting into college are now using spreadsheets. All right, so we were talking about risk assessment. So now we're going to talk about control activities. Control activities include various work responsibilities that help reduce the opportunities that exist for fraud to happen in a company. These activities make sure that for one example I wanted to use is when I was talking about risk assessments, is that many of you are using spreadsheets. So in the bank, it's really important that spreadsheets are maintained for accuracy. And so the bank actually has a program that was developed by one of our internal employees, where it actually checks the risk and does a risk assessment on a spreadsheet. So this operation was instituted as a requirement for all of our accounting folks, especially those that send reports to the regulators. So what this does is it looks through the spreadsheet, it looks for errors, it looks for formulas that are different. I could go on and on about what this little program does, but it is amazing. So so that is one type of control activity. So we call it the SAFER. It's creates an environment of spreadsheets that can be relied upon because they're being tested for the risk. And that's one of the control activities that the bank does, amongst quite a few other things. But so then we have information and communication. So we want to make sure that people within an organization are informed, and we want to make sure that communications are clear, that they're easily understandable, and that things are communicated. We want to make sure that we support sound decision making, and we can only do that if we communicate properly. And then monitoring activities. Back to the spreadsheet example that I gave you, one of the monitoring activities is that all of the spreadsheets get checked by another internal department, that their sole responsibility is reviewing these spreadsheets for risk assessment, for errors, for components that should be there that are not, because included is a whole template sort of tabs that have to be maintained in order for the SAFER program to work and in order for people to be compliant. So this individual team monitors these kinds of activities. And actually, depending on the risk, it could be a low risk, it could be a medium risk or high risk. Sometimes those spreadsheets are checked every single year. But if they're low risk, then they'll be checked every 3 years. Another kind of control activity is a separation of duties, and we'll get to that in just a moment. But its main goal for the monitoring activities is to determine if what is set up is working. So for example, we want to know, is this control working? Are we looking at reports and making decisions based off sound controls and sound processes? And if they're not, then corrections and corrective actions need to be taken in order to reduce the risk. The relationship of control objectives and components. The control objectives and components apply to all levels of an organization, as we mentioned going into this. Although a chief financial officer and a cashier are assigned different responsibilities, their work combines to achieve the common objectives that the company is trying to achieve. And the components of control are shown here. So you have your operations and your reporting and compliance that we talked about. You have your different functions in the company, the unit, division, organization. And then you have the different control components of controlling the environment, assessing the risk, having control activities in place, making sure people are informed and communications are sent verbally, electronically, or however it needs to happen, and then monitoring and reporting activities. So all of this combined will help to achieve reduced fraud, reduce risk, and save the company money at the end of the day. So these are some principles of control activities. For example, establish responsibility. Assign each task to only one employee. For example, giving a separate cash register drawer to each cashier at the beginning of a shift. Because I've been a cashier many times in my lifetime. If someone else gets into my drawer, even if it's a manager, I won't take responsibility if there's any money missing. So it's usually that person's responsibility for that cash. I used to work for Carowinds, and they would have to go to what was called central cash, where they would go and they'd get a cash bag, and then they take it to they had to leave it closed until they get to the facility where they're working, and then they are responsible for that amount of cash for their whole shift. Managers know that they're not supposed to get in it, and other employees could lose their job if they got in it. So that's something that is a control to establish responsibility and who has the ultimate responsibility. And then this one I touched on, segregating duties. One of the important things that's good for a company to establish is someone works with the cash, someone does the reporting, and then someone oversees it. So it says, do not make one employee responsible for all parts of a process. Inventory buyers do not also approve payments to suppliers. So what that's saying is someone who's buying the inventory, they're not going to approve the payments to pay for the inventory. Your inventory buyers or your inventory control managers, they're going to do what is called a requisition. And of course, this is a lot different in smaller companies, but when you're working with bigger companies, you have enough people that can do these different functions. And we'll get into an example of that inventory in just a minute. And then restricting access. Don't provide access to assets or information unless it's needed to fulfill assigned responsibilities. A good example of that is the cash register. Whenever the cashier leaves the register, she or he needs to lock it, make sure it's shut, make sure that the money is safe. So that is what is not having access to the cash. Information, again, when you are working for a company that deals with clients and their personal information, such as a bank or an accounting firm, that information has to remain confidential. So people cannot just get up from their computer and leave it all open for everyone to see, or leave confidential documents on their desk or in their space. They have to take care so as not to expose that information to others who do not need it, what we call a need-to-know basis. So when you lock your computer, you can only get into it with a password, so passwords are used a lot. Document procedures. Prepare documents to show activities that have occurred. So what that's saying is that have processes in place so that people know what they're supposed to do when and the control activities are documented. For example, paying your suppliers using pre-numbered checks and digitally documented electronic funds transfers. So the checks are becoming kind of stale. It's mostly the smaller companies and maybe utilities and companies that your lower income families have to deal with. They no longer work with checks, but however, it's like what's on the picture, it's numbered. There's only one for that number that is on that account. Or there's electronic fund transfers. So those are transfers of money that go through electronically rather than someone getting the cash or a check and putting it in the bank. And then independently verify, check others' work. I'm not saying that you should be hovering over your coworker who has the same tasks as you, but you want to make sure that you're doing the right thing. And if you do notice something's being wrong, bring it to the attention of managers. You want to protect yourself and your job, and you don't want to, but at the same time, you want to make sure that that employee is being trained properly, because it may not be on purpose that they're doing something wrong. It's just that they don't know. But an example of this is comparing the cash balance in the company's accounting records to the cash balance reported by the bank. Another example is at the end of a cashier shift, the cashier, using Carowinds as an example, is going to count their money. First, they bag all their money up in their bag, then they're going to carry it to the cash office. They're going to count it and get a total, and then they're going to give it to the cash office, and they're going to count it. They're both going to compare the cash to make sure that each is counted correctly, and then they're going to compare it to what the computer says, what the cash register says. And it could be more, it could be less. So as we know, internal controls can never completely prevent and detect errors and fraud for two reasons. Benefits must exceed the costs, and human error or fraud. So an organization will implement internal controls only to the extent that their benefits exceed their cost. So you don't want to be a small company making, let's say, $50,000 a month, but yet you're paying $25,000 a month to pay for a security system. Your benefits are not exceeding your costs at that point. You have to be smart about the internal controls that you put in place. And then your human error in controls can fail as a result, your controls can fail as a result of human error or fraud. So it doesn't, a human error doesn't mean that someone's going to be in trouble. They're not going to get fined. It's just an error. It's just that the control didn't catch it. Whether the employee was tired, maybe they were just not paying attention, maybe they were having a conversation, maybe they were on their phone. Okay, so something just happened. It wasn't at fault. But fraud could occur as well if the controls are not adequately in place. All right, so now we're going to talk about bringing cash into the company and how we record it. So internal control for cash is important, as we all know. The volume of cash transactions is enormous, so the risk of cash handling errors is significant. Bills could be new, especially new bills can be stuck together. You have to admit that a lot of you don't know how to count cash back. You have to have that computer cash register to let you know how much cash back to give. That's one of the reasons I'm an old-fashioned kind of girl, and I love it that we have a gas station that makes their cashiers count back change the way it should be. However, that's not the case everywhere, and so you have those kinds of cash handling errors. And then cash is valuable, portable, and owned by the person who possesses it. So it possesses a high risk of theft. It could go into a pocket very easily. It could slip into a shoe, but whoever has their hand on it is considered the owner for that moment. When it goes into the register, it belongs to the company again. So the business can receive cash in two ways, and we alluded to this earlier. So you can receive cash in person at the time of sale, or you can receive cash remotely, like putting it in snail mail, putting those checks in the mail, or electronically, the automatic transfers to, let's say, paying your utility bills online. Those are your electronic communications and your electronic payments. The primary internal control for cash receipts is to ensure that the business receives the appropriate amount of cash, and then it safely makes it to the bank, whether it's cash, checks, or whatever. So that's I know a lot of small business owners are glad now that they can just take a picture of their check and it's gone on to the bank. If it's a big company and they have a lot of checks and a lot of cash, there is some risk when they're transferring that cash to the bank. So a lot of companies now are refusing to take cash and refusing to take checks. They only do card, or they only do electronic transfers. So when you're receiving cash in person, the cashier scans and these are the controls that are in place, scans the items. So there's a procedures document, and that document indicates the price and the quantity sold. In other words, your receipt. The cashier will collect the customer payment and then restricts access to the drawer by making sure it's closed before it goes on to the next person, and then prepares the cash sheet or closing reports at the end of the shift, totaling the cash that they've collected during the shift. And if it's part of their responsibility, they just check the computer to see if they were off. At that point, it goes to the supervisor. The supervisor then compares the cash that's in the register with the count sheet, independently verifies. So there's the control. It's not the cashier that is doing the actual, let's say, last steps. It's actually the manager that is getting involved here. The manager then stores the cash in a vault. All of your restaurants have a vault, and that's where they it's restricted access because there's usually a lock and key on it or a combination. And I'm telling you, when you're in a fast-paced restaurant and you have to get change out of the vault, it's really hard when you're trying to do that that combination very quickly. All right, so then the last thing the manager does is completes the bank deposit. So in a restaurant, normally at the end of the shift, again, to reduce risk of theft, the manager counts up the deposit, places the deposit slip and the cash into a sealed bag. And so when they seal that bag, then it goes into the safe, and then the sealed bag goes to the bank. No one is allowed to open those sealed bags. Only the bank can. And that is the control that they have on their cash. So now we get to the next department, which is the accounting department. They again are going to compare the cash register records with the cash count sheet and the bank deposit slip. So there's another control of independently verifying what went to the bank, what came in, what should have come in. And then they prepare a journal entry. We'll get to this in just a minute, but as you can kind of see down here at the bottom, it's very little, I know, but there's an added step here, and we'll get to that. So here's an example where cash is received in person. The cashier rung up sales totaling $6,100, but only had $6,097 to deposit, so the deposit was short $3. So what goes into your asset cash account is the $6,097, not the sales, but the $6,097. The sales is going to go in at $6,100 because that is what was rung up on the cash register. And then we have this other account called cash, usually called cash over or short, because it could go one way or the other. And so in this example, it's an expense, so it's going to be a debit, which is reducing the sales. So it looks like this when you're doing your journal entry. You have cash, the actual cash that went into the bank. Your cash shortage is an expense, so it's another debit entry. So your $6,097 plus your 3 is your $6,100. So your debits are equaling your credits, your sales revenue at $6,100. Similar thing when cash is received from a remote source. A remittance advice or something that tells the accounting department to book this transaction. It could be just a statement. It could be those things that come with your bills that you just tear off and you send with the payment. That could be what makes it to the accounting department. So the cash manager will take that slip, confirm received, send it on to the accounting department, and then send the money to the bank. When it gets to the accounting department, they're going to do things a little bit slightly different. So this is an email to the accounts receivable saying they have paid this amount, the $75.10. Please deduct it from this person, the supplier, the super supply company account receivable account. So I'm going to talk about this a little more. I think there's another example here in a moment, but the way this would look is that your debit is going to increase your cash because $75.10 is going into the bank, or has already hit the bank, rather, because this was something that came in electronically. So you have $75.10 as a debit into your cash account, and then your accounts receivable, like I mentioned, it's going to decrease. So your debit of $75.10 and your credit of $75.10 both are impacting asset accounts. Your cash and your account receivable, both asset accounts. Same thing happens when you're paying a bill. You send a check and you're going to reduce your bank account and you're going to reduce the liability. Most cash payments involve writing a check or completing an electronic funds transfer, but in rare cases, a company pays for purchases with dollar bills and coins. For example, just small purchases, they may have a little box with maybe $200 or $300 in it that they might, okay, so a lot of times restaurants will need something from the grocery store. They ran out of something, they need this ingredient to do what they need to do, but they generally don't have like a credit card or something to use for those transactions. So they'll keep this $200 or $300 cash fund, and they'll say to one of the cooks, hey, here's $20, go get us some bananas. So they'll run over, the cook will go over to the store, get some bananas, bring the bananas back with the receipt and the change for the manager. The receipt and the change goes into this box. The primary goal of internal controls for all cash payments is to ensure that the business pays only for properly authorized transactions. So when that cook brings back the receipt, the manager is going to write on it what it was used for and why, confirm the amount of the sale and confirm the change. The change plus the receipt needs to equal that $20 that she gave it. Right, so now we're going to talk about cash paid by check for purchases on account. So the first step. Earlier in the discussion, I mentioned that our inventory manager is going to create a purchase requisition for items that are needed in the manufacturing department. So they do this purchase requisition, and it's requested by Kelly, who has to have it approved by Jordan. So once it's approved, then the next step goes into a purchase order. So then you have your purchasing department. They are going to receive the purchase order with this authorized purchase requisition. They're going to place the order for these supplies. And then from there, the order goes out, and if it's the same day, next day, whatever, 2 weeks, 3 weeks, when they get the inventory, they're going to get a receiving report or something, a receipt or something that's going to say, we received these items. And then along comes with that is an invoice. So then a check is written, or the company sends the funds by electronic fund transfer. Most companies pay cash to their employees through EFTs also, which are known by employees as direct deposits. Love, love, love direct deposit. No longer do we have to go to the bank to cash the checks, wait in those long lines on Fridays. So very, very good process. And many, even small companies are using it. QuickBooks has a very good payroll system that I've used for years with a couple of clients. So it's really good way to pay your employees. To reduce the risk of the bank accidentally overpaying or underpaying an employee, many companies use an impressed system, which means an accounting system where it does all the calculations, it goes through some processes, it has to go through approvals as well. Managers need to approve it, and then you push a button and it's all done. Now, getting back to the petty cash system, this is where I was talking about the little box with $200 to $300 in it. So it's used to reimburse employees for small expenses, or like we just mentioned, giving a 20 to the chef to go get bananas and bringing it back. These are just small, very small items. Okay, I thought I missed something. I'm sorry. So controls from bank procedures. Banks provide important services that help businesses to control cash in several ways. Number one, they restrict access. They put money in the bank. Your businesses trust the bank to keep that money safe. They're documenting procedures, and they're independently verifying. So the banks will help business owners set up these kinds of things in order to, again, prevent fraud and implement control. One of the things they use is a bank reconciliation, which is a part of their statement. I'm sure a lot of us in my generation are still using that handwritten bank reconciliation. It is an internal report prepared to verify the accuracy of both the bank statement and the cash accounts of a business or individual, meaning it's taking the money and all the transactions that went through the bank and comparing it to what you think you should have, whatever's in your system. So this is an objective that you want to grasp because it is in the exam in your test. So here we have a bank statement. It's going to list the date, what the transaction description was. Notice it just says check 100, check 101. This is the way most banks that I've seen will do their checks, because they're not going to go in and enter where the check was paid to for every single check. They're just going to put the check number and that's it. They get it electronically off the bottom of the check. So all that you'll see on the statement is the check number and the amount. Now with your electronic funds transfers, you are going to see a little bit more details. But then you're going to have your withdrawals and your deposits, and then your balance, a running total. So these are reasons for the bank reconciliation. Number one, your bank may not know about some things like bank errors, which do happen. Time lags, deposit that you made recently may not have been posted yet, or checks that you wrote may not have cleared the bank yet. Then there are some things that you may not know about. For example, the interest that the bank has put into your account. Maybe you have a special checking account where if you have maintain a $25,000 balance, that $25,000 is actually earning interest, but you're still using the other funds that go in and out of it. You may not know about some of your electronic funds transfers, which I'm guilty. I'll have set up some things for automatic draft, automatic payment, and then it goes through my account. I'm like, where's my money? I go to the online banking and oh, I forgot about that. So when you set up those kinds of payments, you want to make sure and keep track of them, because it could cost you NSF charges. So another thing you may not know about is the service charges taken out of your account. If it's consistent, like on a savings account, it could be $5 a month. You know that that's coming out. But sometimes, depending on what kind of account you have, there could be other charges that hit your account. Customer checks you deposited for which the customer did not have sufficient funds, they come back on you and they charge your account back for that check. You can, and most times usually do, ask for the money from the customer. That's why it's important to have their information at the top of the check. And then there could be errors that are made by the users. So here you have two things. You have your statement and you have your cash account. You see that the balances are different. On your statement, it looks like about $10,600 and some change. And then on the cash account, you have your $11,391. So we need to figure out what is different, what is making these balances different. And it does not mean that the statement is totally correct or this cash side is totally correct. It just means that there are some things that happened in the checking account at the bank that did not hit your books yet, and vice versa. So here we go. At the end of June, there has to be some things done and need to be identified. For example, identify the deposits in transit. So here's a deposit in transit, meaning that the cash at the end was here, but it did not include this deposit that we made yesterday that is in our books. So that is a deposit in transit. And then you want to identify the outstanding checks. So these two checks, we know we wrote, the customers just haven't, whoever we paid just hasn't cashed them yet. So the bank doesn't know they're outstanding. So in this case, we have the 145 and the 815 added together is the 960. So we're going to take that amount from our adjusted balance here to come up with the 11,478. So then on the company's books, you're going to record the other transactions on the bank statement and correct your errors. So here's interest that we received from the bank. Here's the ending balance that we have on our cash account, and then the interest. And then we have an electronics fund transfer received from a customer that we didn't know about. Hopefully we have some kind of documentation about that so that we can apply it to the right customer, but that gets added to your cash balance. And then deductions would be your non-sufficient fund check from a client, so they're adding that check back, your service charges on the account for $6, and then there was an error in posting check 104, so rather than, let's say, you wrote $100 when actually, you wrote or entered $100 in the computer system or the check ledger, but the check was actually written for $109. So where you thought was 100 was actually 109, so you're having to take out the difference. So now, with all of these adjusting entries to the bank statement, notice this is not to the bank, it's only to the bank statement. You're figuring out what the bank has not recorded yet. Doesn't mean that it's not going to be recorded. After a while, if you don't see these things transpire, then that's when you want to reach out to your bank, but not at this point. But at the end of the day, your balance here matches your cash balance. So how are you going to record those entries that you had to make over here? Again, let me reiterate because I don't want you to get confused on this. The items that you have to put on the bank reconciliation sheet do not get posted to your cash account. These are just items that the bank has not cleared yet. What you're going to post are the things that adjust your cash balance or the cash balance of the company. So the first one, the interest that you received, is your interest revenue. So you're familiar with this. You're going to debit your cash because your cash increased, and you're going to increase your interest revenue. The customer sent you $100. Again, your cash goes up by that $100, and you're going to credit the account that it belongs to, whatever customer that might be. The next part is the check that was rejected by the bank. The customer still owes you, so your account receivable is going to go up and your cash is going to go down because the bank is going to take their money back and make you go after it. And then service charges. Your bank charges your debit expense and you credit your cash. And then finally, you're correcting that error. Notice again, you are not correcting the check amount that was originally $100. You're only putting in a journal entry for the difference. So this $9 is the difference between the 100 and 109. So here we have after the reconciling the entries are posted and the cash balance matches the bank reconciliation. You're $11,478. So on your assets, there could be some restrictions to cash that have to be kept separate from your operating cash. So many companies will have different cash accounts. The first one is always going to be cash and cash equivalents. This amount can be used for whatever the business has needs for. So it's readily available, it can be spent, it's there at the top of the list. But then let's say the company goes and gets a loan. So they are going to get a loan, but they are required to keep a cash balance in a separate account for future payments or for some like a collateral on that loan. So that's why they call this restricted cash. It is there for a purpose and cannot be touched. Sometimes companies are contractually required to set aside cash for a specific purpose and are not allowed to use it for their day-to-day purposes, and that's the reason for this 153. And then there are some restrictions like in a franchise. A franchise like Domino's, the parent company may ask their owners to set aside $118 million for advertising, and that has to be used on advertising. So again, these funds are restricted, so they're putting it into an advertising fund, and it's restricted, and they can only reduce this as they buy advertising for Domino's. So this is a little bit more about reporting cash. All right, just a couple more things on the petty cash system. We talked about how it gets put into a fund. Usually it's in a money bag in the safe, $200 or $300 usually. Sometimes a petty cash system is maybe just temporary. When I work a golf tournament for a nonprofit, I have a cash envelope with $300 to make change. But it could also be used if we run into something where we need some supply or something for the golf tournament. We'll use that money as long as we get a receipt, and at the end of the day, your receipts and your cash equals $300, we're good to go. But that money is put into a fund, and it's kept the same amount, whether it's all cash or cash plus receipts. It's all the same amount continuously. It never changes on the balance sheet, never. It's $200 or $300, but it never changes. The only time you're going to do transactions is when you want to go replenish the fund. So you establish the fund, you pay money out of the fund for different little things throughout the month, however time period you want. Sometimes people will just rack up the receipts and they'll just do it when they run out of cash. Sometimes a company at the end of the month, again, you want to recognize your expenses in the month that they were created. So they may, at the end of the month, take their receipts and do the next thing, which is replenish the fund. The way that looks is, all right, this example is using $100. So they're putting $100 into a petty cash fund. So what this looks like is that your bank account is going to be reduced by $100, and then this little envelope that stays in your business or in your office always stays at $100. It is also on the balance sheet listed as petty cash. So you have two cash accounts, one's going down, one's going up. Okay. Here is there's this receipt, like you see here, petty cash receipt that can be used. It's important to get your approvals. Some companies, like a restaurant, they'll just sign the receipt, and a manager will sign the receipt saying that they okayed the purchase, or they may do a little more formal and make out this cash register receipt. So we have $21 for the checker cab. So in our petty cash, sometimes I think they miss some things. Let's just check. All right. When the amount of cash in the cash box runs low, the petty cash custodian asks that the fund be replenished. To support this request, the petty cash custodian presents a summary of what was paid. So what they're asking for is to replenish the cash. For example, the custodian over the petty cash requested a check for $67, and what that person will do is they'll take the $67 check and they'll take it to the bank and get the cash in whatever denominations they need and take it back and put it in their envelope. So what happened is they paid $40 for supplies, and then they also paid travel expense for $21. That was the taxi. Office expense for $6. Maybe they had to run out and get some paper for the printer. But this one for supplies, it's not an expense yet because we just went and bought the supplies and brought them back and put them in our inventory. So that's why you see it here on the debit. And this is what the journal entry looks like. You are increasing your supplies, increasing your travel expense, increasing your office expense, and then decreasing your cash. So that ends the lecture for Chapter 5. Look forward